Howdy, everybody. Welcome to Liberty Call. Today is Friday, May 2nd, 2025. Hope you're having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado. A little on the chilly side, but the sun is out. The rain is done. Just in time for my oldest and his wife to travel back to Florida. So it was crappy all week. And today that they flew home, it is just amazing outside. So me and the puppies have had a little playtime, a little extra here in the front yard. And anyways, all right. Well, to why you're here watching, all three of you, markets wrapped the week on a high note as April's jobs report crushed expectations and trade tensions cooled, at least temporarily. The Dow popped over 1%, powered by strong hiring, a tariff pause for everyone but China, and fresh risk on energy and transports, banks, and chip stocks. So before we close out the week, I need some help from you. If you could do me a favor, give me some thumbs up, a like, share, subscribe, and follow, and press that darn notification bell. All righty. Well, where are we going next? Let's go to the markets. All right. Dow Jones was up 1.39%, 564 points, closed at 41,317. S&P 500 up 1.43%, 80 points, closed at 5684. NASDAQ up 1.51%, 266 points, closed at 17,977. The VIX was down today, 7.97%. It's at 2264. Canada up 0.95, Brazil down 0.09, and Mexico down 0.77. In Europe, looks like all the exchanges were open today. Germany was up 2.49%, the UK up 1.17%, France up 2.33%, Netherlands up 2.25%, Spain up 1.2%, Italy up 1.92%, Switzerland up 1.18%, and the one outlier, Portugal down 0.38%. In Russian exchanges, both down today at 2.7% for the MOEX and the RTSI. And the overnight Asian markets, the Nikkei in Japan was up 1.04%, Australia up 1.13%, New Zealand up 1.17%. It appears most of the Chinese markets were closed except for the Hang Seng, which was open. It was up 1.74%. And that is it for those. Good stuff, I know. Pretty exciting. Pretty exciting stuff. All right. Well, let's bring up our chart and look at the last week and see how things have gone. All right. So starting out with Friday's candlestick of last week, the Dow Jones is going to finish the week up 3.13%. About. Let's see here. The S&P 500. There we go. It's going to finish the week up 2.8%. NASDAQ up 2.89%. The Dow Transports up 4.18%. And the Dow Utilities, that looks like about right, up 1.8%. So all in all, not a terrible week. So let's zoom out to how the markets are shaping up. So this is basically year to date. What we've had is downtrend really starting at the beginning of February. And, we've had a couple of upswings. This one, it may appear to be breaking through. It's a little early to tell. But if this loses steam here, zoom this out a little bit. Yeah. As we can see, we're breaking the above 50 on the relative strength indicator, which is a good sign. That typically means that there's some momentum behind the market. And same thing, everything else. The histogram is in the green. It's trending positive. It's still in the negative territory, so that's not a great sign. But anyways. So that's where the markets have been shaping up so far this year. We started the year on a nice upswing going into the inauguration, and then since February 1st, we've been in this downtrend. All right, so those are our charts for the week. Do you feel smarter? I know I do when I talk about the charts. All right. Well, let's get to the economic data that came out this week. We have a lot of it. Starting out with initial jobless claims, they came in at 241,000, above the 224 forecast. Previous number was 223. Continuing claims came in at 1.916 million. Forecast was 1.86 million. Previous number 1.833. I'll just close these windows. It's easier that way. Let's see. Goods and trade imbalance came in, or goods trade balance came in at a deficit of 161.99 billion. Not great. Exceeded where we were 2 months ago at 1.55 billion or 155 billion. Actually, let me just close that. Retail inventories, excluding autos, grew by 0.4% this month. Previous number was a 0.1. Next up, wholesale inventories month over month grew at 0.5%. Forecast was 0.6. Previous number was a 0.5. The U.S. house price index came in at 437.3. Previous was 436.7. So it did go up a little bit. The house price index year over year grew at 3.9%. Previous number was a 5%. Let's see here. Month over month, home prices only grew by 0.1%. The forecast was a 0.3. The consumer confidence index came in at 86. Forecast was 87.7. Previous number was a 93.9. So as you can see, starting with, what was this? Normally gives me a little pop-up. Anyways, it's probably like December is what it looks like. So basically since December, it's been trending downwards. Oh, come on, work with me here. There we are. Okay, the job openings and labor turnover survey job openings report came in at 7.192 million jobs open in the economy. Forecast was 7.49 million, and the previous number was 7.48. Gross domestic product came in at a contraction of 0.3% for Q1, which is not great. But under the circumstances, with all of the imports that we saw coming into the U.S., which we go back a couple of charts, we can see that the goods trade, or the trade balance. That's the word I was stumbling over. The trade balance being so negative is actually a negative, it creates negative drag on the GDP numbers. So it's not really surprising. Actually, I thought it would be worse than that. The ADP non-farm employment change came in at 62,000. Forecast was 114, so a bit off there. Previous number was 147. Pending home sales month over month grew at 6.1%. Forecast was 0.9. Previous number 2.1. The PCE price index year over year, the personal consumption and expenditures, grew at 2.3%. Forecast was 2.2. Previous number 2.7. And the PCE price index, let's see, what was the previous one? Oh, that was year over year. This is the month. It grew at 0. Forecast was 0. Previous number was 0.4. And the ISM Manufacturing Purchasing Managers Index came in at 48.7. Forecast was 48, so slightly better than forecast. Previous number was a 49. And construction spending month over month contracted at 0.5%. The forecast was 0.2% growth, so a bit off there. And the previous number was 0.6% growth. All U.S. truck sales came in at 14.39 million. Previous number was 14.67. And car sales came in at 2.89 million. Previous number was 3.16. Non-farm payrolls report came out today. Came in at 177,000, above the 138,000 forecast. Previous number was 185. And the unemployment rate stayed steady at 4.2%, right on forecast, same as the previous month. The U6 unemployment rate came in at 7.8%. Came down from last month's number of 7.9. All right. And that is all the data. I told you we had a lot. All righty. Well, let's get to the market recap. S&P 500 rallies amid strong jobs report. Potential China-U.S. trade talks. Potential. They keep saying that. Potential. Possibly. Maybe. All right. The S&P 500 surged Friday, buoyed by stronger than expected jobs data and signs of easing U.S. China trade tensions. Non-farm payrolls rose by 177,000 in April, exceeding the forecast of 138, though March's gain was revised down to 185,000. The unemployment rate held steady at 4.2%, and average hourly earnings increased by 0.2%, down slightly from March's 0.3. Despite concerns over recent economic weakness, the labor market's resilience, particularly employers' hesitance to lay off workers, helped support investor sentiment. Well, if their revenues are down, they can only hold off on laying people off for so long. So we'll see how long that lasts. Adding to the market's optimism, China's Commerce Ministry stated it was evaluating possible trade negotiations with the U.S. contingent on removal of unilateral tariffs. The U.S. has recently signed a willingness to engage, offering a potential off-ramp from escalating tensions that have rattled global markets. So they've signed a willingness to engage. It sounds like, here's a contract to possibly go on a date. It just sounds strange. I mean, just negotiate. Come on, get it over with. However, the rally wasn't without caveats. Apple shares fell over 4% after warning of $900 million in upcoming tariff-related costs, despite strong iPhone sales and an earnings beat. Amazon trimmed losses after issuing soft guidance and reporting underwhelming growth in its AWS cloud division. Airbnb rose 1%, even after lowering its Q2 outlook due to weaker U.S. travel demand. ExxonMobil remained flat after topping profit estimates, supported by increased production in Guyana and the Permian Basin. With roughly two-thirds of S&P 500 companies having reported, 76% have exceeded earnings estimates, according to FactSet. While economic and geopolitical headwinds remain, Friday's gains suggest investor optimism is holding firm, at least in the short term, driven by hopes of trade resolution and continued labor market strength. I still don't think it's going to be enough to hold off the potential downturn that we will eventually have to should go through as far as our market cycles. So I don't foresee us escaping that, short of the Fed, dropping rates to zero. I personally think that they'll wait for some sort of a black swan event, the stock market going down dramatically or something like that. But we'll see. I mean, they may just increase or lower rates just to be nice, but I doubt it. All right, got a data report here from First Trust, April employment report. Mr. Robert Stein put this together. The U.S. labor market showed surprising strength in April, despite the ongoing trade disruptions following Liberation Day tariffs. That's in quotes. Non-farm payrolls rose by 177,000, surpassing all economists' forecasts surveyed by Bloomberg. Even with downward revisions to prior months, the net job gain stood at 138,000, right in line with consensus expectations. The bulk of job gains came from education and health services, a positive 70,000, and leisure and hospitality plus 24,000, particularly restaurants and bars. However, when excluding these government-influenced sectors, along with federal jobs, core private sector employment rose by 73,000, almost double its 12-month average of 37,000. That's considered especially strong and suggests a healthy underlying labor market. Manufacturing jobs, most exposed by tariffs, declined slightly by 1,000 in April, but revisions added back 2,000 jobs, bringing year-to-date growth to 5,000. Civilian employment, which includes small business job creation, jumped by 436,000, and the labor force grew by 518,000, explaining why the unemployment rate stayed flat at 4.2%. Wage growth remained moderate, with average hourly earnings up 0.2% in April and 3.8% over the past year, slightly above the 3.5% threshold the Fed views as inflation neutral. Total hours worked rose by 0.1% and are up 1.5% year over year, which combined with productivity trends points to over 3% economic growth. Federal employment fell by 9,000 in April and is down 26,000 over the past 3 months. Well, I was hoping it would be down, hundreds of thousands, but, small victories where we can get them. The sharpest non-pandemic drop since 2013, reflecting the Trump administration's push to shrink the federal workforce, which is, counting the military and all the federal jobs. I mean, it's what, 5, 6. I mean, then you add in the contractor jobs on top of that. I mean, it's probably 10, 15% of the workforce. Though short-term economic pain is possible, analysts believe long-term gains may follow as resources shift to the private sector. Finally, auto sales remained robust, with cars and light truck sales sold at 17.3 million annualized pace, signaling continued consumer resilience amid trade tensions. Awesome stuff. All right. Got one last article here. This comes to us via Zero Hedge. Peak earnings pulse. Consumer pullback theme gains momentum. So let's see what's going on here. A wave of disappointing earnings from major fast food chains and consumer goods companies have revealed mounting financial strain on low and middle income Americans. Persistent Biden-era inflation, rising tariffs, and growing economic uncertainty under the current administration are pressuring consumer behavior. McDonald's reported a 3.6% decline in U.S. same-store sales, the largest drop since 2020, citing reduced store visits. CEO Chris Kempczynski acknowledged consumer anxiety, while Citi analyst John Tower noted the pullback was anticipated due to earlier warnings and lower income retrenchment. Wendy's followed with a downgrade to its full-year sales forecast, pointing to a pronounced spending slowdown among customers earning less than $75,000. Chipotle also missed Q1 revenue expectations and reported its first same-store sales drop since the pandemic. CEO Scott Boatwright flagged weakening spending, prompting a reduced sales growth outlook. Starbucks delivered disappointing global results and has now seen 4 straight quarters of declining sales. CEO Brian Nichols's turnaround strategy, dubbed Back to Starbucks, has yet to bear fruit. Yum Brands, who owns KFC, Pizza Hut, and Taco Bell, showed mixed Q1 results, and Procter & Gamble slashed its earnings and revenue guidance amid falling demand and tariff uncertainty. Consumer pessimism was reinforced by the Conference Board's confidence index hitting a 14-year low. The labor market also showed signs of softening, adding to investor concern. According to Goldman Sachs, consumer discretionary stocks have been net sold for 4 straight months, driven largely by short positions. Despite these headwinds, Q1 2025 earnings overall have been better than expected. Goldman's Dave Kostin noted that year-over-year earnings growth is tracking at 12%, driven mainly by margin performance rather than revenue growth. However, whether recent consumer weakness worsens or rebounds may depend heavily on upcoming trade negotiations and tariff policy developments, leaving markets in a state of cautious uncertainty. So it's kind of interesting, both those articles, talking about, the broader economy, but in one, they see it as, actually doing okay. And then the other one, when you're focusing on, the fast food industry, they're seeing that things are actually in a bit of a decline. So, we'll see where things go. I personally think, we're headed into a downward economy and downward market, just simply because, we're due and to go through that market cycle. And, no amount of Fed, interventions, eventually you have to go through it. I mean, yeah, you can postpone it and postpone it and postpone it, which, they've done for the better part of 8 or 10 years. But, at this point, we're going to have to, bite the bullet and just, push on through. So, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, where do you go? DSAFinancialGroup.com. Or your financial planning needs can be addressed there. So give me a call. I'll be happy to help. Hope everyone out there has a fantastical weekend, and I'll talk to everyone again next time. Adios.